Morning, everyone. Thanks for joining us in our 11:15 a.m. Phillip Securities Research morning call for the 25th of July, 2022. For today, we've got a couple of updates from Netflix and SembCorp Industries. We also have a few Phillip on the ground from SATS, Sabana REIT, and Mapletree Logistics. In terms of macro and sector outlook, we've got our FAANGM monthly for June, a brief overview of the US banks' earnings for the second quarter of 2022, and then we also have our usual Singapore week to finish up. So let me just begin with Netflix. They issued their second quarter 2022 results last week. We put out our report with the title "Turning Corner on Negative Growth." So overall, for their results, Netflix grew their revenue about almost 9% year on year for the quarter. They also grew their PATMI about 7% for the quarter. In terms of subscribers, this number grew almost 6% year on year as well. In terms of their overall first half performance, their first half 22 revenue and PATMI currently sits at 48 and 55% of our full year forecast. For the quarter, their earnings beat estimates, mainly because of a $350 million gain from a remeasurement of their euro-denominated debt. They did also have $150 million expense from restructuring. And the most important thing for the quarter is that paid memberships declined by 970,000 for the quarter. In terms of the positives, this 970,000 subscriber loss was actually much lower than expected. The company even guided to an estimated 2 million subscriber loss for the quarter. So overall, when you look at it, I guess the results are less bad compared to what everyone expected, which is a positive for a lot of investors, or at least in a lot of investors' minds. So the company also guided to a healthy third quarter 2022 with 1 million subscriber additions. So this is sorry, give me a sec.
I got white noise on.
Hey Darren, sorry Darren, can you mute your mic, please? Thanks. Yeah, okay, so moving back, the second positive we get is so the second positive from Netflix is that they actually guided to a almost a $1 billion free cash flow for the full year, FY22. So you compare this to last year when they actually lost about $159 million in terms of free cash flow. One of the main reasons for this is that because the company's increasing profitability and as well as its stabilization in content spending. So one of the reasons why content spending is actually stabilizing is that they are transitioning further into producing more of its original content. So right now, about 60% of all content assets are originally produced, so that they're relying less and less on licensed content from other production companies. In terms of the last positive, Netflix is actually partnering with Microsoft to develop an ad-supported subscription tier. So this is something that they've been talking about since their last quarterly earnings. So it's official that they've officially partnered with Microsoft as their tech and sales partner. And one of the main reasons for this is because of the complementary technical know-how and extremely robust go-to-market capacity that Microsoft has, which Netflix can leverage when they rolled out their new subscription tier. So this move should allow Netflix to generate additional higher margin advertising revenue and increase its overall bottom line margins moving forward. In terms of the negatives, similar to the last quarter, we expect the strengthening US dollar to continue to hurt revenue growth. So we expect the continued appreciation of the US dollar compared to other currencies to continue hurting revenue growth by about 3 to 5% in the third quarter of this year. One of the main reasons for this is that about 60% of its revenue comes from outside the US, while the majority of its expenses are actually denominated in US dollar terms. So moving on to their guidance and the outlook, the company actually guided to about 1 million paid net additions for the third quarter of 2022. So this is obviously a lot less than what it guided to for third quarter of 2021, when they guided to that's net additions of 4.4 million. However, it's still about 2 million subscribers more than what they had in this past quarter when they lost 1 million subscribers. So they also guided to year-on-year revenue growth around 5%, or 12% in constant currency terms. They expect operating margins to be around 16% or 20% in constant currency terms as well. We do expect the second half of this year to be slightly better than the first half, especially in terms of net additions. This is mainly due to the seasonality of the company's content schedule, where most of their hits they always save it for the third and fourth quarter of the year. And this is usually the trend where the third and fourth quarter generally you start to see a bit of a pickup in terms of subscriber additions. We're also positive on the company's ability to manage its content spending and grow its free cash flow for this year and beyond this year as well. We still think that secular tailwinds remain intact for Netflix. In a recent report by Nielsen, Netflix actually accounts for about 7.7% of the total US TV market share in June. And this number was up by almost 1% from May. So overall, we maintain a buy with a lower target price of $399 US. Our previous was $427 US. The main reason is because we increased our weighted average cost of capital assumptions due to a rising interest rate environment. So that's all for Netflix. I'll move on to FAANGM monthly for June. So overall, the FAANGM declined 7.9%, while the S&P was down 8.4%, and the Nasdaq dropped 9%. Overall, high inflation, weakening consumer sentiment, tightening fiscal policy, and the increased fear of a recession continue to place downward pressure on the overall market, especially as investors remain quite cautious. However, we remain optimistic on the FAANGM, mainly because we think that long-term secular tailwinds in digital advertising, cloud adoption, and global digitalization remain intact. In terms of specific stocks, Google outperformed. They were down only 4.2%, while Meta was the main laggard, losing almost 17%. So this is just a chart of the FAANGM forward PE. Where we're at right now, the FAANGMs are trading about 27 times forward PE, and this is slightly lower than pandemic lows of 29 times. You can see in this chart. So one of what we see from here is that we think that a lot of the pandemic-induced hype has been taken out of the market, and we think that as the FAANGMs approach their one standard deviation away from its mean, we think that it's an attractive opportunity to pick up some of these fundamentally stable companies moving forward. So in terms of individual stock updates, we'll start with Apple. They launched their new M2 chip at their WWDC, or Worldwide Developers Conference. So they launched these new chips on their new Mac Air and Mac Pro devices, stating that these devices are twice as efficient as other comparable chips, as well as their old M1 chips. They did mention, however, that the new models will be roughly 20% more expensive than previous models, mainly because of the increased price associated with producing the new chips. Aside from that, they had a landmark 10-year deal with the MLS, or Major League Soccer in the US, worth a minimum $250 million a year. So this media rights deal marks the first time a major US sports league has aligned itself with digital media. I believe early on this month, Amazon actually made a similar deal with another large US sporting league. In terms of their third quarter 2022 expectations, consensus estimates put their EPS as around $1.16 compared to $1.30 from the third quarter of last year. So I'll move on to Amazon before Microsoft. So Amazon is actually starting their Prime Air drone deliveries. Should be quite interesting to see. They're starting this service in Lockford, California as its pilot location, and will slowly expand outward after it is able to get enough feedback and data to improve its operations. They also just held their Amazon Prime Day in the mid of July, I believe last week or a couple weeks ago. And this, we think that this would have been a test of U.S. consumer demand, especially amidst the current weak macroeconomic climate. Prime Day is considered to be quite a core driver for Amazon's Prime memberships, which basically leads to overall increasing revenues, mainly because Prime members spend on average about 2 to 3 times more than non-members. In terms of their second quarter 2022 expectations, the company did give revenue guidance of between 116 to 121 billion US dollars. So if you take the midpoint of this, we're looking at a revenue year-on-year growth of about 3%. Estimated earnings per share of about 14 cents, sorry, compared to 76 cents in the second quarter of last year. So on to Microsoft, they announced a quarterly dividend payout of 62 cents US cents per share to be paid out on the 8th of September 2022. So for them, they are wrapping up their fourth quarter and full year 22 this week, I believe, when they announced their earnings. So these are our analysts' estimates of their revenue. So we estimate that their revenue will come in about 53 billion for the quarter, about 15% year-on-year growth. In terms of full year FY22, we expect them to have about a 19% year-on-year growth for revenue. In terms of PATMI, we expect them to come in with 17.6 billion US dollars. And for overall full year 22 growth of about 20% for PAT. I'll move on to Meta. So some major changes for their upper management. Sheryl Sandberg, their COO, mentioned that she was stepping down from her position this coming fall after almost 15 years at the company. Chief Growth Officer Javier Olivan is set to take over the role of Sheryl Sandberg when she departs moving forward. So in terms of Meta's second quarter 2022 expectations, the company guided to between 28 to 30 billion US dollars. So if you take the midpoint of $29 billion, it's basically no year-on-year growth. The consensus estimates that EPS will come in around $2.61 versus $3.61 in the second quarter of last year. Moving on to Alphabet, they're actually allowing, for the first time, they're allowing rival ad placements on YouTube. So they're beginning to ease some of their user data restrictions and offering to let their rivals place ads. One of the reasons for this is because there's actually an EU antitrust investigation into YouTube specifically, and so Alphabet is actually trying to avoid a potential $15 billion US fine, and right now they're actually working with regulators to try and find an agreement that would kind of help them avoid this fine while at the same time appease the regulators. In terms of their second quarter 2022 expectations, the company guided to about a 19% year-on-year growth in terms of if you take their revenue guidance midpoint. In terms of earnings per share, $1.30 for this coming quarter compared to $1.36 in the second quarter of 2021. In terms of Netflix, I won't go into too much detail, but they did mention that they had a second round of job cuttings. So they laid off another 300 employees. That represents about 3% of their total workforce. Most of these employees are actually within the US. And like I mentioned earlier, it costs about $150 million US dollars. Not just to lay them off, but to restructure some of their offices as well. So overall, in terms of streaming, we are still continuing to see streaming gain market share in terms of total TV usage. So streaming platforms had a 32% share in June of 2022. This is slightly old news, but or rather old numbers. But Netflix leads all platforms at 6.8%. Currently, they lead at 7.7%. For the last point, I believe I already spoke about it earlier, so I won't go into that. In terms of overall, we remain overweight on the FAANGM. We still believe that their valuations remain attractive for us. 27 times versus 29 times during the pandemic lows. We still prefer Google and Microsoft, mainly because of the high levels of corporate demand for cloud and productivity solutions. And we do, however, we do reduce their target prices across the board as we increase our discount rates due to rising interest rates. So just to note that in this table, the target price for Alphabet is a little off because this was taken pre stock split. Yeah, so that's all for me. I'll hand my time now to Terence for SembCorp Industries. Thank you.
Hey, thanks, Jonathan. So for SembCorp Industries, we tweaked their first half 22 profits on account of the stronger USEP prices and stronger tariffs in India. In our next slide, thanks. In our next slide, average USEP prices rose about 239% on a year-on-year basis in the first half of 2022, driven by the conflict in Ukraine. Spark spreads have increased as average USEP prices have moved ahead of high sulfur fuel oil in the last 9 months. So if you look at the table here on your left-hand side, you can see that USEP prices have actually trended ahead, especially in the last 9 months of the year. So if you look at the spark spreads for 2018, that's 5.75, and then the spark spreads in the second quarter of 2022 actually surging up to 6.29. So just to define, spark spreads is the difference between the USEP prices and the high sulfur fuel oil, which is actually it's like, you can think about it like the price of electricity less the cost of the fuel. But these spark spreads have actually increased because of the volatility in the energy markets, mainly because of the conflict in Ukraine. Tariffs for power in Tamil Nadu and Gujarat in India also rose 88% on a year-on-year basis as high temperatures in the country drove up power demand in the two places that SembCorp Industries operate in. The second positive we see is gross renewables capacity in operation and under development globally now stands at 6.8 gigawatts in the first half of 2022 from 6.1 gigawatts as at end of last year. So this is actually ahead of our FY22 target of 7.3 gigawatts. So accordingly, we revised up our FY22 capacity to 7.6 gigawatts on account of the group's aggressive build-up of its renewables portfolio. If you look at the chart here on your left-hand side, you can see in FY2020, they only have 3.2 gigawatts of renewables capacity. But you can see the ramp up in the renewables capacity as SembCorp transformed its business from brown to green. They nearly doubled their capacity from 3.2 gigawatts to 6.1 gigawatts. And then in first half of 2022, they continue to ramp it up. They have a full year 25 target, financial year 25 target of 10 gigawatts. So based on their aggressive ramp up, we think they are slightly ahead of their target, and we've revised our model accordingly as well. Last but not least, there's been no directive to halt repayment of foreign loans in Myanmar, contrary to reports in the media. SCI has received prompt payment from its off-taker and continues to operate its Myanmar power plant. Having said that, we continue to monitor the situation in Myanmar closely, and we'll give an update if there's any adverse change. In terms of the negatives in our next slide, The headwinds in the China property market is expected to put a drag on the group's urban development business. This weakened sharply in the past year, driven by two main factors. The first is the government clampdown on excessive borrowings by developers. And the second is the COVID-19 induced economic slowdown. So if you look at the chart here on your left-hand side, you can see that since May 2021 and June 2021 last year, the China property sales have been declining by about 15 to 20 percentage points because of the government clampdown on excessive borrowings. But we see a accelerated slowdown, especially in April of this year, as the lockdowns across cities could demand. Based on April 2022, which is the latest data that we have, the China property sales actually declined 40%. So that's actually quite negative for them. So we expect this to have a negative impact on the group's land sales in China, though the impact is not expected to be very significant, as China accounts for just 6% of the group's total saleable land. In our next slide, in terms of outlook, we expect the first half 22 results to be supported by conventional energy segment as global energy markets rose in tandem with higher commodity prices. The FY22 energy markets are also expected to remain robust with continued uncertainty about the Ukraine conflict. Accordingly, we downgrade our recommendation from accumulate to neutral. The reason why we downgrade our recommendation from accumulate to neutral is because of the recent run-up in the share price. But we upgrade our target price from 294 previously to 296. This as we raise our financial year 22 PATMI by 6% as we bake in higher profits from the conventional energy segment and the renewable energy segment for financial year 22. Our target price is still pegged to 1 times financial year 22 PB, no change. So that's all from me for SembCorp Industries. In our next coverage for Phillip on the ground, we are on SATS. We have no coverage on SATS. So this is this summary is based on their first quarter financial year 23 results. SATS is the main ground handling and in-flight catering service provider at Singapore Changi Airport. For the first quarter of 2023, their key operating statistics improved across the board on a year-on-year basis in terms of flights handled, meal served, passengers handled, and cargo tonnage. All of this improved strongly across the board as the border restrictions eased. In terms of the financials also improved. First quarter 23 revenue was up 36% on a year-on-year basis. PATMI came in at negative $22.5 million without government reliefs. This would have been negative $31.9 million. Share of earnings of associates and JVs also improved to 6.9 million, turning in a positive number from a loss of $1.2 million for the same period last year. This came about because of stronger performance in its aviation and cargo units. The key metric that we are watching though is the core PATMI X reliefs. Core PATMI X reliefs came in at negative $31.9 million. So if you look at your right hand side, the core PATMI X reliefs of $31.9 million is actually slightly better than the $35.5 million loss from last year. So while we are naturally concerned that the core PATMI, if you look at the first chart here, is actually has actually turned into negative territory, especially when we compare with the first quarter of 2022. This is actually in line with the management's guidance because they have actually been guiding since the third quarter of 2022 that they are expecting bigger losses for the next financial year, for the next few periods because they need to ramp up hiring. That's the first reason. The second reason is because the government reliefs that they give will also be tapering down, though they didn't give an exact amount how much the relief will be tapering off by. But you can actually start to see the effects coming through in the fourth quarter of 2022 and the first quarter of 2023 as the company swing into a net loss because of the tapering of the reliefs and also the higher cost of front loading these costs as the government, the company prepares for the ramp up in volume. But having said that, the group has a strong balance sheet and a net cash position of 252 million, no change in their debt to equity. We should see them tide out the crisis. In terms of outlook, IATA also forecasts global passenger numbers to recover to 83% of pre-pandemic levels by the end of 2022. China's zero COVID policy continues to dampen the pace of recovery in Asia Pacific. But having said that, air travel on the whole is expected to increase. So that's all for me on SATS. I'll now hand over the time to Glenn.
Okay, thanks. I will work on Glenn's portion because I think Glenn is in the middle of the IFAS results briefing. So next slide. So what we done is that we don't cover the US banks. But no, we usually just want to have a look, very high level look at the US banks results, just to see, what's possible impact to Singapore banks, at least sentiment wise, because every country is different. So what we did was Glenn did was we took a summary of the results or second quarter results of all the big US banks. So let me just run through. So what did well? So these are year-on-year growth numbers. So what has done well for the banks has been their net interest income. Part of it is because of the higher interest rates, so their margins expanded, net interest margin expanded. And secondly, is also there was loans growth in the US banks. The loans growth, I mean, it ranges, some is like 5, some up to 25. So it ranges about 14% on average, the loans growth. So all this definitely helped the banks. And this is important because it just shows that the economy, or at least the big tailwind for banks, is improving margins and loans growth, which is more recurrent. The thing that is hurting the banks is, if you look at the second last line, the last line, you can see that the bank earnings, the headline earnings was very bad. You can see that the PATMI was down some 30, like Wells Fargo's earnings was down almost 50% year on year, the net profit. But it wasn't because of the underlying economy and so forth. What happened was investment banking was weak. So investment banking is, of course, like someone like Goldman Sachs is a very big part of the income. So there were no deals done, no bond raisings, no IPO. So they all hurt these banks a lot. The main thing that also hurt the banks, which is probably the larger part, is their provisioning. So most of the weakness was because they normalized provisions. If you look at most of the US banks, they actually had positive provisions. Provisioning usually is a negative, right? Because it's an expense. But in 2021, most of these banks had like a few billion of positive, because there are a lot of write-backs by the US banks. And that's why the headline numbers is bad, because they were just normalizing. It wasn't because there's higher provision, but last year they wrote back a lot, and then now this year. So as a result of that, the headline numbers for the banks was actually pretty bad, because like down 50, some down 30. But the underlying isn't as bad, because you can see that the net interest income, the more recurrent, which is actually making money from loans, that's doing well and that's growing very well. Okay. Again, we don't have target prices for the banks. It's just for information, because we want to get a read how it might affect Singapore banks. Next slide. Next slide. So we'll just go through some of the main macro numbers for Singapore. So for Singapore, we had 2 data points on land transport, which is especially important for ComfortDelGro. We had SBS rail traffic. This was a bit dated, maybe 2 weeks ago, but what happened was that they released the real number. So rail traffic, which is the number of people sitting on trains for SBS, was up 77% year on year to 1 million. So this is the highest since the pandemic, I guess. And also, it is just 14% below the pre-pandemic 1.1. The negative news is taxi. This is not Comfort, but the whole industry taxi number. So continues to decline, down 7% to 14,000 taxis. It's the highest decline in terms of units in 6 months. The 136 decline from May to June. We had some export numbers from Singapore. I think the negative here is that overall it's still positive, but exports very volatile because of chemicals and pharmaceuticals. But electronics was surprisingly weak. The exports was only up 4%, the slowest in 19 months. One possibility could be prices, because of the way DRAM and memory chip prices have moved. US numbers, there was some US macro data, but the main read from the US jobless claims is just that jobless claims is unemployment, so it's probably like a precursor before the layoffs. So it's a sign of how many people are getting laid off. So it's the job market is starting to slow. There are more jobless claims, the highest, even higher than the pre-pandemic levels. But again, no, the US has 11 million vacancies, so they can probably absorb a lot of these jobless claims. The other big news last week was the ECB, which is the European Central Bank. So they finally raised rates after 11 years, and they raised it back to zero. So interest rates in Europe was negative. When I say interest rates, I'm referring to the ECB, the deposit facility. So this is the interest rate that you put, that banks, when they put with the central bank, what they were getting. So if you put money in the central bank, actually the central bank will charge you 50 basis points. So they raised it back to wait for it, zero rate now. Okay, but anyway, so one of the comments by the central bank is that they need to bring down inflation to 2%. I think now it's like 6-7% in the medium term. The other thing, again, this is just for information purpose. They introduced this thing called Transmission Protection Instrument, TPI. This will allow the ECB to buy bonds. So because what they worry is that if they raise rates, they might get another, European debt crisis that we got in 2011 to 2013. So it's a bond buying tool. It's like a QE tool, and hopefully they don't have to use it. Just a mere mention of it. But what is happening is that it's most likely going to target Italian bonds. So they worry that the interest rate for Italian bonds will spike up because of all the bit of turmoil in Italian politics, lots of Draghi resigning and so forth. Our tactical view is we still think the market will be more a sideways direction. Why we think so is that the central banks are raising rates even as global growth is slowing down. And that's number one. Number two, of course, a lot of the pessimism has probably been priced in, and that's why we see a bit of bounce. Number three is that the curious thing is that if you look at the US 10-year bonds, they actually now 2.75, which might be even lower than the Fed funds rate by the end of this year. So we think the market is pricing in that the Federal Reserve will actually cut rates by next year, which I think is a bit aggressive. But anyway. If you look at the events to watch out for this week, we have a lot of the FAANG names coming out. So we've got Microsoft, Google results in rate. Then of course the main one is the FOMC rate decision. Market is expecting 75, but we won't be surprised if even 100 basis points could be raised, because the next meeting is almost 2 months away. Then we got Apple, we got Amazon results, and Samsung. Friday we got our first Singapore Bank results, which is a UOB. Some of the webinars we have for this week will be Capital DC REIT now. So if you do have time, feel free to join. It's open to everyone. Then the following week we have SATS and also Prime US REIT and so forth. We also have a US company, a Marathon Digital, and also Unity Software, 25th of August. Next slide. Okay, so just to highlight some of the data. So we have SBS Transit. You can see that there's a big bounce from a year ago. Now it's 1 million people sitting the train compared to 500,000 a year ago. Okay, this one is just the taxi versus the number of rental cars. So you can see that the taxi in yellow is coming down. Rental cars is also more or less quite stable actually. But again, this may not everyone may not be using this for Grab or Gojek purpose, but it's just a proxy. But what we normally like to use is we measure the number of rental cars to taxi. So you can see that the competition is still strong. I mean, in terms of the number of rented cars, but again, there's very little visibility. Now, how much of it is really used for really into the ride hailing services? The ones are unclear, but again, just a proxy to competition. Next slide. This slide, the URA also release, because every quarter the URA will release details of property market stats. So we normally look at the inventory. So this is the inventory. The chart on the left is the inventory of residential, private residential units, which is unsold. So this might be units that already they launched but haven't been sold, or units not launched yet but they got the approval, they bought the land. So you can see that there's about 15,000 amount of properties, residential units available for sale. And this is, although it's a bounce up from the lows, it's still very low compared to, I don't know, maybe 2019, the high was almost 35,000. So inventory is still at record lows. The other thing to note is the red line. So the red line is like how many years it takes to sell this 15,000 inventory. It probably takes about 1.5 years. I mean, it depends on how many you sell because it's a past 12 months. Whereas the average, normally developers will hold almost 3 years of inventory, 2.7. Right now it's only 1.5. So what it means is that that's why I guess AMO, I think the most recent launch was AMO, was like sold out. Everything was more or less sold out in one weekend. The 300 units. The price, this is big, this is in Ang Mo Kio, Bishan area, it's about 2001. And like you highlighted, unlikely residential price will come out because there's just basically no inventory, and the developers don't have to rush. They got like 4 years to sell. So the longer you wait, it seems to be like the better the margins. The table on the right is just to show the amount of transactions. Again, this is more a real estate agent chart. So quarter on quarter, is the down 12%. So it's still going to be a weak year on year. So we think the real estate agent results, which is very obvious, is going to be quite weak because the number of transactions have come down. Next slide. Okay, this is just an illustration of ECB. Again, none of us really monitor Europe, but again, just for information purposes only. The table on the left is the red line is the inflation in Europe, which is almost 8%. The blue line is they call it the deposit rates. Basically, it's like the Fed funds rate, but this is the European version of the Fed funds rate. So you can see that it was negative for almost 8 years. I guess we never studied that in the textbook before about negative rates. But it's now back up to a 0. So even then, you can see compared to the red line, interest rates are still very low in Europe. The table on the right, again, just for illustration, this is the Italian-German bond spread. So how you calculate is assuming, let's say the interest rate in Italy is 5%, then Germany is 3, just for argument. So the difference is 2. So you can see the big spike in 2011, 2012. So this is when we had the European debt crisis. Everyone was worried, Italians might default and so forth. Until Draghi said they will do whatever it takes. So I guess Lagarde is coming up with her own version with the new bond buying program. But you will notice on this chart on the right that the spread is actually climbing back up. I mean, it's something for us to monitor, but I wouldn't be too worried about it because since Lagarde, the ECB chair, has mentioned that they're virtually going to go in and buy bonds in the market. So it's like another version of QE. So we shouldn't expect another European debt crisis. Hopefully. Next slide. This just for information. We did a quick check because we thought we had a bit more time. So we did a quick look at all the Chinese data. You can see on the left, the amount of residential space sold in China is probably one of the worst in the last decade or more, because the data is only up to 2010. So this is a year-on-year number of the property sold. So it virtually collapsed at the amount of property, but it seems to be rebounding a little bit. This is another important thing, which what we do is, loans in China is controlled by the central bank, I guess, by moral suasion or loan quotas. So you can see that in 2020, when the pandemic hit, the government really injected a lot of liquidity. That's why loans go spiked up to 2021. Then it started to go sideways or even down. But right now, you can see that I think the authorities are injecting again liquidity back into the market. So that is positive. Market as into the economy. Next slide. This is just to gauge demand. So this electricity demand is also a reflection of the weakness in the Chinese economy. It collapsed quite a lot to even negative. Imagine negative electricity demand. The other thing on the right is a bit volatile, but this is China retail sales. So if you look at 2005 to 2011, when the government made stimulus and China was like the best consumer market in the world because the retail sales was almost like 20%. Then right now it's gone negative and it's still, it just shows that the Chinese economy is pretty weak because it's the retail sales, which is unheard of. It's supposed to be, China's supposed to be the golden goose for consumers. But of course, with the pandemic and so forth, but you're beginning to see also a little bit of improvement in the data points. Again, this is just for information. Next slide. Okay, we'll just do two last Phillip on the ground. Phillip on the ground is just, for those who cannot attend, we'll just brief you. So Sabana REIT is the smallest industrial REIT, all in Singapore, only 18 properties. Most of it is high-tech and so forth. So their dividend yield, their dividend is up 7% year on year. in the latest results, and for the first half, their dividend yield is about 7%. So for them, I mean, what they mentioned, most important for them, in this environment with rising interest rates is rental reversion. So the rental reversion, if you look on the right, was about 9.1%. So one of the reasons is those who are a bit more familiar, New Tech Park used to be an industrial building, then they revamped it and got permission to add in retail. So because of the retail, then the tenants are willing to pay higher rents. After all, now you got an NTUC there. I mean, why not? It used to be an industrial building. Then they improved car park. Then they provided childcare facilities. So they will tell the tenant, it's almost similar to moving to a new building, rather than you move, rather than relocate. This is a new. I give you a supermarket now to your industrial building. The other thing is that, of course, utilities, a lot of questions will be on cost. So they just wanted to mention that for industrial buildings, the common area where the REIT has to absorb the higher utility cost is usually 10-15%. The malls were the ones who feel the most, because in malls, the common area as a percentage of GFA is about 30-40%. But he said not only just utilities, everything is rising, all the costs, security, detergent, I think you can read the landscaping. So they have to raise the service charge. In terms of this is a bit more micro, some of their, because Tuas is always a bit of a worry for them because there's a lot of supply coming into Tuas, but they mentioned some of the developments in Tuas, they're getting they're working on new tenants. Their focus is on master lease. So one of the reasons they are doing master lease, if you look at the bullet point supply, is that the government recently mentioned the government lands, which is the IGLS, which is for industrial land government sales, that they're going to release 1.35 million square feet, which is a lot, which is higher than the first half. So they're just a bit worried that that the supply, once the government release and then someone bids and they build, right, there's going to be a lot of supply in 2024. So they're a bit worried. So that's why they want to master lease as fast as possible. For them, it's a bit more nuanced because they only got 18 properties, right? So they can't afford to take any risk in any one properties. But when you look at Ascender's got 100 properties, so probably for them it's not such a worry. But when you're a smaller REIT, I guess you have to be a bit more careful. Every property count. The other thing is interest. So the interesting thing for me is that all the REITs like to say hedging, but if you want to hedge now, the hedging cost is 150 basis points. So hedging means if you want to fix your interest rate, so let's say your variable rate now, which is the floating rate, is maybe 2%. So if you go to the bank, you say I want to hedge, so that all the analysts say you're doing well because you hedge. But hedging is also expensive because you have to pay another 150 basis points. So there's only a limited amount of hedging a REIT can do. It might maybe help you the next 1 to 2 years, but you cannot forever hedge because eventually it's going to catch up with you. So the outlook for them is that the key for them is the rental reversion. So they think they can continue to grow the rental reversions. But we did some simulation. If 150 basis point rise in interest rate, it will cut the DPU by 13%. But of course, they got hedges, so that will protect them at least the next 1 year or so. Next slide. Okay, okay, so this one is Mapletree Logistics, my last video on the ground. So Mapletree Logistics, for those who may not know, they're mainly an Asian industrial REIT, one of the largest. They got 185 properties. Most of it is in 1 quarter in Singapore, 1 quarter in China, then probably another quarter in Hong Kong and Japan. So they mentioned that I don't think it's announced. What they say is available DPU. So they don't announce quarterly, but their DPU is up 5%. So if you analyze it, I think their yield is about 5%. If I'm not mistaken, yeah, should be, yeah. Then the other thing is they mentioned for China, since 1 quarter, they say that China rental reversions is probably only 2.5 to 2.8. Rental reversions in China not as strong as in the past, and most of it is tier 1 because in tier 1 cities there's scarcity of supply. The problem will be second tier cities because the one is going to hurt. So I don't think they can get rental reversions in tier 2 cities. What they worry longer term for them, I mean, as a foreign investor into China, is that they just worry that the Chinese policies might affect foreign investor sentiment because for them, they're building warehouses, factories. Important that foreign investors continue to invest to build factories and so forth in China. So they're just worried the policies will affect the investments. The other worry is domestic consumption, no? Because if domestic consumption is weak, means you don't need so much warehouse, you don't need so full worry. So these are the two big macro things that they worry about. In terms of acquisitions, you know, when you have 185 properties, you know, organic growth, which is your normal rental, is not going to help your growth. So you need to rely on acquisitions, and they said that they have about 2.5 billion, which is huge considering. Yeah, so they got about 2.5 billion of assets to acquire from Australia, Japan. But the problem they have is that it's not easy to make acquisition, because there's a lot of inflation pressure, and then you got rising interest rates. So as a result of that, they can only buy if there's a 5% cap rate. So cap rate is, again, this is just rental yield, no? It's like you rent out your apartment and then how much yield you collect based on the rental you collect. So it's a fancy word for that. They just call it cap rate. So what's happening is that to get a 5% cap rate, because of rising interest rates, they need to value add. So nobody's going to sell you such a nice 5% rental yield if maybe there's a bit of space issue of getting, they need to do a bit of renovation, they may need to find tenants and so forth. So that's why it's not so easy. And one of the reasons is because if you look at the cost of debt, so let's say you buy a property, don't have to be, you buy any property now, 5% rental yield, but what if your interest used to be 2%, so you collect 3%, right, extra? That means your rental, you collect more than you pay the interest. But now that is shrinking, because if they refinance their debt now, the interest will jump from 2.3 to double, basically double to 3.7 in Singapore dollars, or even more for Australian dollars. So it's not going to be easy. So imagine if you buy something 5%, but your interest is 4%. That means your carry, they call it carry, that means your rental over interest is very limited. I think in Indonesia is negative. That means your Indonesia interest is 8, but your rental is only 5. So you actually better hope there's a lot of rental growth, otherwise you cannot cover your interest. So okay, so sorry to drag this, but in terms of the outlook, what we see is that there's going to be multiple challenges for a REIT in general to grow. Because for me, I'm just worried, I'm not the REIT analyst, but at least there's the upside from capital appreciation is a worry. First, you're going to face two pressures. So for a REIT to grow the DPU, first you need to make acquisitions. So you need inorganic acquisitions. But the spread, as interest rates rise, it's going to be very thin. In the past, sorry to go there again, maybe you buy 4% cap rate, your interest is 2%. So you got at least 2% of carry. Your rental can pay interest, but with interest rates rising so much, you may not have enough buffer. So a lot of acquisition is going to be difficult. And the problem is that a lot of investors view real estate as an inflation hedge. So you don't going to get expansion of cap rate is going to be very challenging, because there's still a lot of liquidity out there chasing after real estate. Yeah, I think I'm probably confusing a lot of people, but anyway, if you have, just ask some questions. Okay, so the other thing is, so assuming you don't grow by acquiring, you grow by raising your own rent, that is also going to be a challenge, because if you, let's say I did some simulation, so assuming interest rates rise by 150 basis point from the 2.3, right? So what it means is that the additional interest is going to be 75 million for Maple Tree Logistic Trust. It's going to dilute the DPU by 17%. So what it means is that for them to maintain dividends, their net property income, you can see from the middle, basically the net rental that they get, need to grow by 12% over 2 years. So to stand still, that means just to maintain dividends, they need to grow at least 6%. So that's going to be a challenge, especially if you're a big REIT. Maybe for Sabana, it's easier because they're small. So you need to grow just to stand still, to maintain dividends. I'm not talking about growing your dividends because of the interest expense. But the caveat here is that you won't feel it this year because they hedge. So most of it has been hedged. You won't feel it this year or even next year, but you will feel it maybe in 2025 onwards, unless interest rates drop dramatically. If not, growing DPU for a REIT is going to be challenging because of the high interest rates. The other part is just to mention that no, you're not being paid. Again, this is a bit more very complex, but let me just try to explain. Sorry, but what I'm trying to say is that 31st December, based on 190, your DPU, your dividend yield was right now is 5. When I calculated, it was 4.8 like that. So right now your dividend yield is 5.2. That means as a REIT investor now, you're giving you extra 40 basis points. So because the share price down, right? So you're being paid extra 40 basis points. But am I being compensated when interest rates up 150? When interest rates up at least 100 basis points? So what I'm trying to say is that you're not being compensated as a REIT investor. Not enough, I guess. But again, it depends on the view. Maybe if you think interest rates coming down, then it's fine to buy. But what I'm saying is that the REIT prices haven't dropped enough to compensate me because of the higher interest rates. Yeah, okay, I'm not probably very confusing, but anyway, next slide. Okay, okay, this one is just my last slide because I have to do some share investor conference on inflation, no, investing in the inflation era or period. So we were looking at so one of the slides just to share is, since we're talking about real estate as a hedge. So this is the performance of various asset classes from 1965 to 1985, you know. That was the period when the US had such a huge high inflation rate. So we wanted to be curious now, so what assets did well? So the inflation rate is in red in the US. In beige column is the periods when inflation in the US was double digit. So during those periods, inflation was probably 11%, 15% inflation rate. Of course, now it's 9%, it's not very far away. So what assets did well was actually number one was commercial real estate. So commercial real estate actually outperformed the inflation. Again, I don't have the reason why. Maybe because of the replacement cost, it was getting more expensive. What didn't do as well was, of course, equities. Excuse me, equities is in yellow. It just went sideways or declined. You can't see the scaling is probably down as much as 20% or more. The worst sector was utilities, because they're getting a fixed return. Surprisingly, just one last point is the beige line. So the gray line is basically profits. So actually, the US has all sorts of data. So this is the amount of corporate profits before tax. So what it shows is that actually during inflation, corporate earnings actually can grow. They manage to grow in line with inflation. But the problem with the equity market is that there's a de-rating of the PE. You can't see here, but when I look at the numbers, so 1965, for what it's worth, before inflation happened, the PE of the market was about 18 times, 17, 18. Then when inflation hit and interest rates jumped to 18%, the PE was probably dropped down to 7, 8 times. So what we get is that during inflation times, one of the reasons why equities drop is because the valuation will collapse by half. I'm talking about the 1960s to 1970s. Okay, I mean, next time we'll do the better illustration. But again, just for everyone's information. So actually, surprisingly, commercial real estate actually performed very well, even better than inflation. Okay, okay. Thanks everyone. Yeah, sorry, it's not a bit long. Yeah, we can move on to Q&A.
Yeah, I'll just take a few questions for Netflix. Okay, so got a couple questions here. What is free cash flow versus just cash flow? So free cash flow is basically your operating cash flow minus capital expenditure. In terms of cash flow is your operating cash flow, and and you have to include your cash flow from investments and cash flow from financing. So just some accounting terms. So specifically on Netflix, is Netflix a dividend paying stock? If so, what's the dividend payout? So Netflix doesn't currently pay out any dividends, like most big tech companies or most tech companies in general. The way that they derive or they add value to investors, so they say, is that they do share buybacks. Yeah, but generally they don't really do any dividend payouts. This question has been asked also during one of the earnings calls, and they have basically said that they will not be issuing any dividend payouts in the foreseeable future. So next question here is Netflix worth a long-term investment with so much competition and other external factors? So yeah, I mean, in our view, Netflix is definitely still worth the long-term investment, especially right now it's trading pretty low, I believe, 12 or 14 times PE. Way below its 10-year average and even below the Nasdaq's average. But at the same time, Netflix is synonymous with streaming, and I guess that is partly half the battle won when your product is synonymous with, for example, Google, right? No one really says, I want to Bing something. Everyone just says, I'm going to Google something. I'm going to Google this, I'm going to Google that. Similarly to Netflix, when people want to go and watch stream a show online, they just I'm just going to watch Netflix. I think that is brand awareness and brand domination is half the battle won. In terms of competition, yes, it's increasing competition, and that is driving up some of the expenses across the board. But for Netflix, when you look at some of their metrics, like even though they haven't really been growing in terms of subscriber base, but when you look at the average revenue per member or the ARM, it's still about it's almost twice as much as Disney, which is largely considered its main competitor in terms of a pure video streaming platform. It's tough to compare Amazon Prime because the main product of Amazon Prime is your Prime shipping. Also in terms of for Netflix, they are like I mentioned earlier, they take up about 7.7% of your total US TV market. I believe Disney is, if I'm not wrong, like 3%. So it's way down in terms of viewership hours. So in terms of competition, there's always a lot of talk about competition for streaming, but as of right now, Netflix is still the leader by quite a long shot. Yeah, I think that should be it on Netflix. So sorry, I have this one more question. What ETFs do you suggest for FANG? For the FANG, we usually just pick the QQQ, the QQQ, which is a ETF that tracks your Nasdaq 100. Main reason for this is that the FANGs constitute about 40 to 45%, I think, of the total weightage of this ETF. Yeah. Okay. That's all for me. Thank you.
Yeah, I think I'll jump in to take the next few questions. SCI is very capital intensive, highly geared. Valuation is based on price to book. Will it have lower valuation with other valuation methods like P or cash flow? We usually expect high income yield for a utility business. SCI does not provide that. So is SCI a good long-term investment? So I think there are two questions here. I'll take the first question first. Will you have lower valuation with PE or cash flow? So we look at PE and cash flow, but they're not as appropriate to use as PB, and that's mainly because in the last couple of years they have certain impairments that affect their overall earnings, and in 2020 they actually had SembCorp Marine inside their business as well. So when you look when the SembCorp Marine that inside the business, then that affected the volatility of their earnings. So what we did was to look at price to book because there's a little bit more stable, especially when we strip out SembCorp Marine. Is SCI a good long-term? So yeah, long-term investment. Yeah. So usually you expect a high income yield for a utility business, and I think SembCorp Industries have realized this. One of the things that they are trying to do, especially based on their 5-year plan, is to really try to pivot their business from a business that focused on fossil fuels, which was a lot more volatile and had lower margins, to one that is focused on renewables. So that pivot is important because if they pivot towards green energy, the margins and the return on equity is much higher than if they focus on conventional energy. And also because of that, we believe there will be a re-rating of the company also because of higher profitability and also that ESG label. So if earnings is a lot more stabilized, which we believe it will be, then we believe SCI is a good long-term investment. I'll move on to the next question. BRC Asia and Pan United, any comments on these counters that from your previous reported target price from its current price, given that both are quite illiquid? So we believe BRC Asia and Pan United continues to benefit from the overall construction recovery in Singapore, especially in 2022, as the construction continues to recover. The forecast from BCA, which we rely on a lot, continues to show strong growth, especially in 2022. We like BRC Asia and Pan United because both are market leaders in their respective industry. BRC Asia have 2/3 of market share and Pan United have 40% of market share in the construction recovery. So to us, they are proxies for the construction recovery and will thus benefit from the rise of tide in the construction recovery. Both are at a significant discount to our target price, and they trade at about 8. They are trading about 4 times for BRC Asia, 4 times of financial year 22 PE, but both are giving average of 10% dividend yield. So we think they are both still a good buy at these levels. Let me just scroll down to see if there's any more questions for me. I think that's all for me. I'll hand over this to the rest of my team.
Hey, thanks, Terence. I'll take the bank questions. Give me a minute. Let me just put it up. Okay, so where do you go? Okay, please comment on the Singapore bank stocks and China bank stocks. Sorry, I can't comment on the China bank stocks, but Singapore bank stocks, yeah, surely I can comment on that. So Singapore bank stocks, mainly the outlook and what we would expect to see would be that the rising interest rates would further benefit their net interest margins and net interest income. So this was sort of shown already in their first quarter results, but it was as all 3 banks have mentioned that the main bulk of the rise in interest rates will only benefit them in the second part of 2022. So this is just a sort of a starting of what you could expect for their net interest income. And the second thing that we would be looking at would be their allowances. So allowances, we don't expect it to increase significantly as the sort of areas that the banks are in are quite stable, and all the ASEAN economies are just starting to open up. So we wouldn't expect that to increase significantly. And okay, so what bank stock would you recommend? So we would, our pick for the banks would be OCBC. And this is because of, excuse me, due to their attractive valuations and the upside in dividend as well from the 15% CET1 buffer. So their CET1 is actually the highest amongst all 3 banks. So DBS, I don't have the figures off the top of my head, but they are the highest amongst all 3 banks. And as well as lower provisioning as the Indonesian and Malaysian economies recover. So what happened in the 2021, that fourth quarter, was that they were hit quite hard by the Indonesian and Malaysian economies. So their NPL, their non-performing loans and non-performing assets rose significantly as compared to the other 2 banks. But this was dialed back down in the first quarter, and we can see that it has improved their PATMI and their net profits. And yeah, so that's all I have for the banks. Let me see if there's any more questions. Okay, I don't think so. I'll hand it over to the rest of my colleagues. Thank you.
Oh, okay, thanks. Yeah, sorry for the delay. Okay, let me just try to answer some of the REIT questions. Okay, so with interest rates stabilizing, will this help the REITs remove the risk? Oh yeah, it will definitely help, because then you'll be at least better clarity of when you are making an acquisition. No, there's better clarity, like how much carry. Again, sorry to use system carry. It's like how much the difference between your cap rate or the rental yield versus your interest. Because if not, then you keep on chasing, because the cap rate, then you will be, there's less certainty. Like, what if I buy cap rate at 4 and then my interest rate go to 5? Then my goodness, and my negative carry, then there better be like rental growth, right, if you have a negative carry. So being stable, it will help. Then at least you can, otherwise you will hesitate because you're not sure what is the actual interest rates that you have to pay when you make acquisition. Can you give an update on Yoma? Really, there's nothing much to update. We don't have any particular information. We'll wait for the quarterly results, quarterly updates if they do give. Then but apart from that, really nothing much from us. It's more like what's happening on the news. So sorry for that. Can't really give much. So I go to the most upvoted ones. Hi Paul. So you're saying that REITs are not good investments in the current climate, given the rising rate, and we're not being compensated enough. Yeah. Okay. Just to give you a bit more context. So if you look at the Singapore savings bond, I mean, just as an example, right now the 2 years, we cannot go so long, right? Most of us, because if you look at the REIT, maybe you only have a 2-year view. So if you look at Singapore savings bond, the yield now, I'm not the exact number because it keeps on moving, but maybe it's like 2.6%. In December, it was 1%. So what we're just trying to illustrate is that even the Singapore savings bond has risen by 150 basis points, or 1.5% now, roughly. But the dividend yield for someone like Maple Logistics Trust hasn't really moved much. I'm just giving an example. It's probably like 4.8% dividend yield to maybe now 5.1, 5.2. So the move is only 40 basis points, which unless as an investor you think there's going to be a lot of growth, but again, like we mentioned, it's not good. It's going to be challenging to grow. So my own thoughts is, again, we are still waiting for a REIT analyst. What I'm thinking is that since I'm not compensated enough, I would rather wait. I mean, right? Because it hasn't dropped enough. That's what I mean by being compensated. It hasn't dropped enough, and I'd rather wait, and as after the Fed starts to more or less do one, or maybe after this June and maybe after September rate hikes, when interest rates already kind of been kind of like heavily factored in, then maybe it will be a better time to buy. The only caveat is that if people start to believe that the Fed has probably more or less peaked and going to cut rates on it, then there's the different ballgame. Then this thing will start to run. But that's what I'm just saying. I think this will be what any bond investor will look at. Theirs is a bit more sophisticated, sorry, but this is more, they will look at the corporate bond yield versus the government bond. So in the US, you look at the yield spread between a corporate bond, and that hasn't widened. So if I'm a bond investor, I would say, since it's not widened, I might as well just buy a government bond, because I'm not being compensated for the extra risk. So this is a similar kind of framework that we are using. I hope that kind of explains it a little bit. Yeah. Would you please explain the difference between trading in the US Asian hours that was launched by POEMS versus conventional trading method? Okay. So we just launched trading in Asian hours. So you can trade US stocks between 9 to 5 p.m. Do note that from 4 p.m. there's a formal pre-opening trading. You can actually go to our website to get more details, but let me just give you some key points. That's number one. So you can trade 9 to 5 Asian hours, Singapore time. Number two, there's only 30 stocks. Because we are like virtually market making on this, so there's only 30 stocks. Usually, your big FAANGs, the most popular stocks. Number three, there's a minimum of 5,000 US dollar per trade. Number three, the commission is, I think, 8 basis points. So the commission is very low. But do know that I think if you go in, the bid-ask spread can be a bit wide. So you have to be take note of that. But apart from that, if you want more details, you can call our talk to Phillip and all that to get more details. But that's generally the main framework. So you can actually trade like any normal, but I think the spread might be a bit wider than what you get in like the US Nasdaq normal US trading hours. I think trading in Asian, because in Japan it's quite it's quite a normal thing to trade Asian hours, but of course it's not so formalized for retail. So I think we're opening this up for retail. What is the property stocks outlook for the next 3 years? I think I'm not sure about 3 years, but at least for this year, the developers, I'm referring to developer stock, I think they should still do well. The only worry is whether the government come back in again. So that's always going to be a nagging issue. But I think for this year, all the property stocks will announce very good results, especially for CDL, because they're going to have very cheap land bank. Their source of cheap land bank, I think like Terence might have mentioned before, is from their CBD, because they like CDL, right? They kind of like, I wouldn't say hot, but they kind of stored a lot of land bank, good land bank in the CBD area in the form of an office building. And then now the government say, oh, your office building can sell residential units, and I give you just to top out a little bit. It's like, wow, it's such a windfall. I wish I had that. But anyway, so unlike the other developers, CDL has very cheap source of land bank from the CBD restructuring. So they got 2 buildings in CBD, and they got another one that's outside CBD. So that's why for the smaller mid-cap names, you won't see earnings growth, but you can expect good dividends from a lot of the smaller ones, because they're going to get a big windfall. Because once all the projects are done, right, then all the money will come back in. Because most of them, for a small developer, they won't put in equity because they want the money back fast. So they'll put in loans. So you'll see their cash, the net cash of a lot of the developers will spike up, and we think there could be dividends coming in. But of course, but the problem is going to be growth. That means if they want to grow, they got to go back into the property market and buy. So most likely, M Block could be the one to get the land bank. I don't know. Yeah. Okay, let me just try to answer as much as I can. For MLT, a part of its DPU is from capital distribution. Any idea where this capital distribution is from? I assume this is not from net property income. Does this inflate? Yeah. So you're right. I don't know whether they give the details, but capital distribution is, I wouldn't say it's it kind of camouflage, right? Because you want the REIT to pay from rent, not to so capital distribution comes from the sale of properties. So I think like SCOT has almost 200 million of capital. That means they sell so many properties, they got like it's a cash reserve. That means the profits that they generated from selling the previous properties. So distribution is usually from all these sales that they made. Does this inflate the yield? Yes, it definitely can inflate the dividend yield, because essentially you want the REIT to just pay out from real yield. You don't want it to be like some of those Chinese REITs in the past that got like guaranteed, minimum guaranteed support, and all that. You want to look past that. You want to look through, and investors generally look through them. Yeah. Okay. There's news about Singapore hotel rates hit a 6-year high as tourism recovers. What are your comments? Yeah. That's definitely so. I think we mentioned this before in some of our presentations. The room rentals in Singapore now is even higher than pre-pandemic. I think you can try yourself. You can try and book, but so it's going to benefit hospitality. And the reason why we still like hospitality, especially Escort, is that we think this is, sorry to repeat, maybe those have heard it, so I apologize, but we are only in the early stage. So the first stage we say is leisure travel, second stage is business travel. The third stage is going to be China. I mean, I really do not know when, but if China comes in, you can imagine all these hospitality risks will just zoom back up again. So we think we're only on the first stage of the travel recovery. It's still going to be, after all, the opening only happened in 28th of April, right? I mean, our so-called Freedom Day, our Singapore version of Freedom Day, I guess. US, I think this one I can. Any thoughts on CSCT? I think this one we can brief you once the results is out. Right, Darren. The results coming out this week, right?
Yeah, correct.
Oh, okay. Yep. So we will try to brief you for CICT. Yeah. Oh, sorry, my volume dropped. Yeah, I didn't realize that. Yeah, I'm trying to speak quite largely. Is it possible to have more coverage? High power, is it in future? Is it possible to have more coverage on China tech stocks instead of FAANGs, as China tech stocks are really all-time low and there's no upside. Yeah, okay. We have to yeah, thanks for the question. We really can't do that because for China, we got our China team. So we got our Hong Kong analysts and they got China analysts, and they are definitely much better, more well-informed than us, like I don't know, 100 times better than us in covering China tech. So we don't have an edge. Imagine Singapore analysts covering China when there's a Hong Kong analyst. Frankly, nobody's going to listen to us, right? It's like the China analyst covering Singapore stocks. I don't think that anyone's going to listen to China analyst. So that's why sometimes when we do coverage, we can only do US and Singapore. We can't do expand more. Yeah. But thanks for the question. I hope you understand. Hi, Paul, what's the impact of movement of Fed funds rate and 10-year government bond on the equity market? They seem to be moving in the opposite direction. US and Singapore government bond yield decreasing and Fed fund rate increasing. Yeah, I agree. Yeah, I guess what you're trying to say, yeah. So there seems to be some inversion in the curve. Inversion for those means that it's like inversion means your 10-year deposit FD rate is lower than your current deposit, like your 1 month deposit rate. I mean, an example, which is ridiculous, right? Obviously, I want to pay more. Yeah, I think because I think the market is assuming rates are going to cut. Yeah, and what is the impact? Usually, it means there's going to be a big slowdown or recession coming. I guess that's one indicator for it. Yeah. Sorry, I'm not sure how to answer that. Yeah, that's the main thing because the yield inversion, I guess you're referring to. Okay. Okay, there's quite a lot. Anyone wants to take the rest? Can you take the bank one first? Glenn, this one on DBS UOB.
Right. Yep. I'll take that one. Thanks, Paul. Okay. So is there a particular reason why OCBC is trading at a lower PNAV, so this price to net asset value, this few years as compared to DBS UOB, even with the higher CET1 ratio? Okay, so if you're comparing these few years and you want, if you're talking about the CET1 ratio, OCBC was actually only quite recently had the highest CET1 ratio. And this is mainly because both DBS and UOB had acquisitions. So they had the Citigroup acquisition. So this lowered their CET1 ratio. So, and also, furthermore, DBS had that MAS additional requirement. They were hit by that as well. And it was, I think it was quite a bit larger than the one that OCBC was hit by. So DBS's one was due to they had error in, they had some system malfunction, so their online services were shut down for a few hours, and then so they were hit by this additional allowance. So this also hit their CET1 ratio further, and OCBC was hit as well quite more recently, but this was due to the phishing scam, the WhatsApp SMS phishing scam. So it was hit slightly, but they are still the higher CET1 because they did not have any major acquisitions. So I would think that, yeah, this is quite recent, this CET1. Just let me look down and see. Okay, I think I'll hand it over to the rest.
Okay, so thanks for that. John, do you want to take this US earnings season?
Yeah, sure. Yeah, so I think there's a couple of questions on US. So the first question is, how do you see the ongoing US earnings season so far in light of top analyst estimates being over-optimistic? Well, first of all, I'm not sure I can say the analyst estimates are over-optimistic. I'm not sure. I haven't really heard much talk about that. But in terms of what I think the US earnings season would look like, I think we would see a very muted earnings seasons. I mean, everyone expects, or rather, I don't think there will be a lot of outperformance. But at the same time, expectations are already pretty low for a lot of the companies. So it'd be very difficult to see Well, it would be quite interesting if a lot of companies don't meet their estimates. That will spell really bad news for the stock market in general. But it won't be like previous earnings seasons where you see companies beating estimates by like 50%, 40%. Yeah, and that just is due to the generally weaker macroeconomic situation that has been ongoing for the last 6 to 9 months. So I hope that answers your question. There's another one on US semicon stocks. US semicon stocks have rallied recently. What is the outlook for Nvidia and other semicon stocks? Yeah, so semicon stocks are quite heavily tied to growth stocks, because of all in the way that they in the way that the price moves. So naturally, if you see a lot of your growth stocks starting to, or if you see a lot of investor sentiment turning more positive, the first things that you see rarely would be growth stocks. And obviously, if the US semicon stocks are heavily tied to that, then you see them go up as well. And the same would be, like during a market downturn, you see all your growth stocks, your discretionary stocks go down quickest and hardest, and the semicons just follow that same kind of behavior. Let me see if there's any more. I don't think there is any more questions from me, so I'll pass the hand back to Paul. Thank you.
Oh, okay, thanks. So let me read out the next question. Hi, Paul. Genting tanked last Monday after management indicated that they were not pursuing with MGM. Why do you think Genting is climbing up a week? On example, pure market sentiment or possibility of more suitors? I think Genting went up because Las Vegas Sands reported the results, and inside those results, Marina Bay Sands did very well. I think their revenue doubled, I think year on year. So because Marina Sands did well, so people will, logically they will assume that Genting should also report very good results coming out. The other thing is also, my guess is that Genting is probably going to announce some bumper dividends. I mean, that's what they hinted in the last briefing, that they will give out good dividends, and they will have a formal dividend policy. Because Genting always like to hoard cash, like that. So, but I think this time round they mentioned they would have a formalized, and that could help the stock. Considering pre-pandemic, this stock was probably like 90, depending which period, 93 cents. So those were the two that was the main news of Marina Bay Sands results, which was reflected in the US listed Las Vegas Sands. What is the estimated share price drop to be attractive on the increased interest rates? If you're talking about REITs, again, it's probably another 50 more basis points, I guess, for like Mapletree Logistics. Maybe the yield hit like 5.8, almost 6. Then maybe you're being compensated. I mean, I guess that's the right term. I'm not saying it's a fair value. Yeah. Outlook for Fraser's property. Yeah, sorry, we don't have anyone looking at it. But again, whenever there's a results briefing, like when Genting releases the results on the 12th of August, we'll definitely brief everyone. So hopefully when Fraser's does something, we will try to. Otherwise, we don't really have any update. Which commercial REIT is good? My own guess is actually I thought the European REITs would be good. Again, it's my own personal view, because the European REITs, they have an inflation hedge to it. So their rental is going to rise in line with the CPI. To the extent I'm really not sure, but I guess like someone like Cromwell, that most of their rental is indexed to the CPI. So I thought that would be, at least you're protected in that sense, that any inflation increase you covered. Especially when Europe inflation now is like 8-9%. What are the implications on the inverted Singapore bond yield curve on equity? Again, it's just there is no real implication. Maybe it might be more for the US banks, the way they price the loans, but Singapore banks normally price their loans at the short end, and they use 3 months HIBOR or now SORA, right? So it won't hurt the bank margins. A bit of again, getting a bit technical here, a bit of gapping thing, because they like to climb, they like to go up the yield curve to get extra yield for their bond portfolio. Now they can't do that, so it might affect a bit of their trading income. The third thing is maybe there is some messaging effect. No? It shows that the market expects interest rates to drop because economy is going to slow down again. So it might be negative for the equities market. It's a bit more of a messaging thing. But if I have time, let me go and we'll work out on the yield, Singapore bond yield curve and recession in Singapore. We really never done that. We usually use a US, but that's something that we will try to do and show everyone. Whether when the yield curve inverts, whether it actually is a message for recession in Singapore. We never really did it for Singapore because US market is the main thing, right? Because even if it inverts Singapore, nobody's going to pay it. Probably won't even be in the newspaper until recently, I guess. Any view on CICT? Sorry, we don't really have. Paul, highly appreciate your explanation on yield spreads and REITs. What should a normal spread be between Singapore savings bond, Singapore government securities yield versus Singapore REIT yield? Does this spread change with changes in market factors and market environment? Yeah, okay. So just to explain to everyone, so the yield spread means, if Singapore government bonds is 2%, how much should a REIT be in historical sense? Typically, in the past, it was, I think, between 3% to 2.8 to 3%. It depends. I was looking at the data earlier. So you can round it up around 3. It doesn't mean it's exactly 3, but usually investors want one additional 3 percentage points over government securities before they then they think it's worth. But again, this is a historical average. Then of course sentiment will go up and down. In the rising interest rate environment, I can only guess that the yield spread will widen more because people know you cannot grow, you cannot acquire so much. When it's coming down, I think it will shrink because you can acquire means you can grow TPU. So if you cannot acquire means you cannot grow TPU. So it's like a bit of a virtuous cycle, yeah, where the share price actually affect the business. Okay, let me try. There's quite a lot here. Hi Paul, is Sabana REIT is cautious on supply of industrial space? Would it be a negative impact on the prospects of Mapletree Industrial Trust, as MRT is mainly Singapore industrial space? I think it's very hard to broad brush that. For Sabana, I think, like we mentioned, they are very small. They only got 18 properties. So if 1 or 2 don't get tenanted out, they're going to hit them very badly. So for Mapletree Industrial Trust, my only guess is that most of them are like high-spec buildings, warehouses, tier 1 assets. I think they're less of a worry for them. And also do note that if you look at the pipeline of property assets, there's a lot of investments coming into Singapore. There's, I think, 3 to 4 wafer fabs coming in. If you just look at the pipeline, so there's Hyundai. Hyundai is also coming to Singapore. So there's also a lot of FDI coming to fill the space. Because when Hyundai comes, it's not going to only take.
I think Paul seems to have lagged out. Just give us a sec, sorry. Yeah, I think I can take this question. There's a question on semiconductors. Could you give some info on the supply chain issues faced by semiconductor companies? Is there any indication that the supply chain issue has improved? So we don't really cover semiconductors, so I'll try my best to answer this. As of right now, there aren't. The main issues that we get from the main supply chain issues are obviously were a couple of months ago where a lot of the shutdowns in China, factory shutdowns kind of caused a lot of supply issues, not just supply chain issues. But at the same time, there has also been weakening demand for a lot of durable goods like like your electronics and stuff like that. So and at the same time, overall production or overall kind of economic activity has been slowing down. So those have been some of the kind of headwinds for semiconductors. In terms of any indication that supply chain issue has improved, right now we're not really seeing any indications that it has improved as of yet. Yeah. Yeah. But I mean, when you look at some of these semiconductor companies like NVIDIA, they do look quite attractive right now. Some of their forward, it's interesting that the sector in general, the forward PE is very similar to like the forward PE of a consumer staples sector. So definitely something you can take a look at. In terms of the, I'll try to take this one. For a suggestion, please invite one of your Hong Kong colleagues to share on Hong Kong China tech. It's a good opportunity now to share their knowledge and expertise on Hong Kong and China. So we actually did have a US, Hong Kong and China webinar, I believe last week, where we had one of our colleagues from Hong Kong do his quarterly strategy and as well as stock picks for some of the Hong Kong and China counters. So we do have this every quarter, and he has done it for the last 3 quarters as well. But if you do want to find out, or rather if you do want a bit more, I think we'll probably have to check with Paul on that. Yeah. Paul, are you back? He's back. Okay.
Yeah, so sorry. Yeah, we will try our best to get a Hong Kong colleague, but we're not sorry for the disruption, but not too sure whether they even have a Hong Kong tech specialist. So we will try, but because usually they have their own, so we'll try our best, but I still think it's going to be unlikely to get them over on a regular basis. Yeah. Okay, it's almost okay. Let me just try to wrap up most of this. Can you give some examples of a small developer that will benefit? Some of this will be like KSH. I think KSH is a developer come contractor. Yeah. So these are the ones. Oxley, I wouldn't call them a small developer, but Oxley, then the other developer, what was the one with Lian Bing or SP Land, is it? Yeah. SP Property, I think that's the other one. Some of the small ones that they will get a windfall from all these projects. What are the commercial risks you recommend? Yeah, I think we can't answer that. How can we access the Hong Kong analysis then? I think you might have to go to the Stocks BNB or on our Poem's website to get some of the research from Hong Kong and China. Yeah. Do you have any chart that compares Singapore inflation versus assets? Like, okay, let me try to do that. Because Singapore don't have such a so long dated. Because US has up to 1970, data series up to 1970. So Singapore may not have, but let me try to see if there's any data. But even commercial property, yeah, I can try to get some URA data, but I'm not sure. I'm not sure how far it will go, but let me try to do that. So I'll try and do the yield curve and also this one. Yeah. Do you think the recent events in Pakistan will impact markets in Singapore? We don't think so, but I guess Pakistan has nuclear weapons. So, but again, just jokes aside, we don't think so. I think the effect is like when Sri Lanka event happened, it didn't really, of course, very tragic, but it didn't really impact the markets here. Because we don't have any exposure, any stocks with exposure in those countries. What do you think of Manulife? The price is low as of much. Yeah, I found it attractive. Just that I think the market is just very worried of the ability to, firstly for Manulife, one one problem is that they have the long WALE. So long WALE is usually used to be very good, like we mentioned long WALE, because your tenants are stuck with you. But long WALE also means that you cannot grow your rents. It's typically, right. I mean, if I'm going to sign long WALE, I'm not going to let you raise my rent every year by 5-10%. So that's the one overhang. And number two, is just that people worry with the work from home phenomena, whether there's extra. Yeah, but I myself find it attractive, but I think that's the worry the market has. I think it will take a bit of time, maybe by end of this year, for people to know that the worst is over for them. And yeah, in terms of, I think people are worried that they might lose more tenants, and some of the buildings might have issues. I think that's the thing. What other stocks interesting? I think for us, we actually like what we do. For us will be even Del Monte, we thought was quite interesting. But all these are in our absolute 10 model portfolio. Okay, I'm trying to rush all this. Paul, any views on Olam in the next 3 to 6 months, taken the context commodity? For me, the whole restructuring, Olam's all about the restructuring. I think I hate to keep repeating this, and sorry, it's a broken record, but you just have to wait for the markets to improve, for them to IPO their Olam Food Industries. That's the only trigger for this stock. The listing of OFI, and then they will do a dividend in specie, which will be, on paper, maybe 2-3 times bigger than the current listed market cap. I think that's about it. I'm not so sure about the earnings and so forth. Hi, Paul. With current interest rate inflation, REITs may underperform. Where can we take shelter? Short dated and 3-4 seem to have corrected to the attractive level. I think shelter will be the short dated assets. I think short dated. So sorry, I'm not really sure how to answer this. I guess just park yourself in cash. I guess that's the only shelter. Yeah, sorry, I'm not really sure how to answer this. But for me, I think some of the stocks are already a shelter. Some of the stocks in Singapore, like again, sorry to keep talking, like banks, they're already paying you 4% dividend yield. There's going to be earnings growth. So I think there's already kind of shelter. And for me, broadly speaking, equities is a shelter to those that got high dividend yield, 4-5%, because most times companies only pay 50% of the profit as dividend. As the whole Singapore market is paying 4% dividend yield, and their payout ratio is only 50%. So what it implies is that it's not like a REIT. A REIT pay everything, right? There's no reserve. But for any listed company, they normally pay half. So their balance 50% can still help you grow. Again, this sounds like a textbook, but that's the advantage of assets for equity. So even the STI ETF, at least they can give you a 4% yield, and you still got that growth compared to a bond. I guess that's sounds like textbook. On a weekly basis, okay, that's going to be tough. I need to check because I think you're referring to Hong Kong analysts coming here every week. Yeah, it's going to be tough. We will try, but I doubt that they will want to come because they are more focused in their own markets. Yeah. What are the companies in Singapore related to semicon? Example, AEM is one. Yeah. So the two main ones will be AEM, which is a major supplier to to Intel, and UMS. Sorry, the voice logo. Okay, so the two semiconductor stocks is the two main ones is AEM, which is a supplier to Applied Materials, and also to UMS. In a way, although semiconductor is down, I think both look interesting in the sense that semiconductor foundry capital expenditure is still very strong. You can see that even Samsung is looking to build up a lot of semiconductor capacity in the US. UMS is interesting because UMS has by end of this year, they may announce one very big customer because they've already set up a whole factory for this new big customer, right? So although they say they cannot tell you who it is, but they build such a big factory, not going to make it empty for badminton court or something. So obviously they're going to have a big customer there for so that's why for me, UMS also look interesting in the sense there's a potential for a new customer. Yeah. So sorry, the voice is a bit low. Yeah. Okay, I think we answered most of it. Just one last note. I know a lot in the past came to our weekly briefings because there's a charty. So we are waiting for our technical analysts to get to get licensed, and then once he's licensed, I think we can do more technical analysis in our current on Singapore stocks in our current webinar. So just be patient a bit, so that you don't have to keep on asking me all these fundamental questions, which I guess going to be boring for you. So we will have our chartist coming on. You're just waiting for licensing, and then he can help address any technical chart questions that you may have. But just give us some time for the licensing thing to happen. So anyway, with that, I'd like to thank everybody for your time, and also have a good week ahead. And thanks for all your questions. Bye-bye.